doing the presentations. But yeah, we'll get started, and I'm recording it just so everybody knows, so that we can have a record of this for everyone else that wasn't able to join. So with that, I'll just mute myself as well, if everyone can mute themselves, and we'll let Katie begin. Thank you.
Thanks, Natalia. I'm just going to share my screen, and then hopefully everyone can see the slides. So just hold on 1 second. Can everyone see the slides now? Is that working?
Yes, very good.
Great. Yes, so as Natalia said, I'm Katie House. I'm a Senior Research Analyst at Climate Bonds Initiative, working predominantly on the Climate Bond Standard, and I'll explain a bit about what that means. And yeah, today wanted to chat with you all about green bonds and forestry, and what we're doing in the forestry space, and kind of the green bonds that we're seeing coming out of the forestry space at the moment. So thank you all for joining and being interested in the topic. So I'll start off, I'll give a really brief intro to Climate Bonds Initiative, because I'm not sure how well everyone knows us. And then I will do a very brief bit about green bonds as well. I know there was a previous webinar a few weeks ago on green bonds, so I'll just give enough to give the context here. And if there's more questions to answer, then let me know. I'm just seeing some of the words aren't coming up. Anyway, I'll explain why I'll explain what I was meant to say there. Yeah, so I'll do a brief bit on green bonds, then we'll go on to the forestry green bonds that we've seen in the green bond market so far, and then talk about why we believe that there's forestry criteria are needed in the green bond market. And explain that we've got these criteria out for public consultation at the moment. So I'll hand over to Louise, and then I'll give an overview of our criteria, which are currently in public consultation. So really especially happy to take questions and comments on that part of the presentation, but really on anything that I present. Sorry, I didn't actually talk to this one. So Climate Bonds Initiative, what we do. Our mission is to mobilise debt capital markets for climate change solutions, and we have 4 kind of core work streams around that. The first is market data and market analysis, and that includes analysing every single green bond that comes out into the market. So whenever a green bond is issued, we look at the use of proceeds, and we make a judgment as to whether that green bond is really classified as green, and then we make a call as to whether to include it in our database or not. Our database then feeds into a couple of indices. It feeds into MSCI Barclays and S&P Dow Jones indices. So the call that we make as to whether to classify a green bond as green has implications sort of further down the line in the indices and things like that. The other thing we do on the market side is we analyse pricing, because there's a lot of interest in whether green bonds attract a better pricing than regular bonds. So we've done quite a bit of analysis on that, and that's ongoing analysis. And every year we do a state of the market report to explain what's going on in the green bond market, how big it's growing to, where we're seeing growth, giving details about the countries, the types of issuers. There's a wealth of data out there about that, and we try and report on that every year. We also do policy and market development, so that includes building policy models and giving government advice. We work with we work with developed and emerging markets, but do try and focus quite heavily on emerging markets to grow the issuance there, because they need a bit more support. And we also serve on a number of technical groups. So the EU last year had the EU high-level expert group on sustainable finance, of which we were part of. The recommendation for that was then to take that on into a further group. So just recently, a technical expert group for the EU has been kicked off, and we're also a part of that. The icon that just says setting by it, which I don't know why it's missed off the word, but that's meant to say standard setting. So and this is the area that I work in particularly. So We also do standard setting, and this is about writing criteria for what sort of projects and assets can be included in green bonds. It quite often gets referred to as green definitions, or creating a green taxonomy for the projects, so for the projects that what they need to meet if they're going to be included in a green bond. An example of that could be if, for example, if an issuer is looking to do a green bond related to transport, what emissions threshold does the transport have to adhere to be eligible for green bond financing? But yeah, I'll talk about that in the context of forestry today. And then the final thing that we do is we have a certification scheme, so climate bond certification. Bond issuers can use this certification scheme to get their bond checked either before issuance or after issuance, and that's to kind of give it the tick mark to say this third-party verification has been done, that the green bond that is being issued really is green. And the purpose of that is really to give investors the confidence that they're getting the climate or green credentials they think they are when they're investing in a green bond. So yeah, that's Climate Bonds Initiative in a nutshell. So now on to the green bond market. So this graph here, this just shows that, so the first green bonds were issued in 2007 by the EIB and the World Bank. This graph here shows 2014 to 2018, because that's when we've really seen this market taking off and quite rapid growth in the market. So key figures here. Last year we saw 161 billion of green bonds issued, and that's 85% growth compared to issuance in 2016. We're expecting the issuance to continue growing around the same levels, and we're kind of predicting about 250 billion of issuance by the end of 2018. You'll see in that graph we're not quite halfway there yet, but what tends to happen is the second half of the year does tend to be a busier green bond issuance time. So we're still hoping that target is feasible and that we will get to that 250 billion. And the overall target that really needs to be reached if we're to get where we need to be with climate financing is 1 trillion a year by 2020. So there's a lot of growth still to happen, and there's a lot of growth still to push for. It's something else I wanted to point out quickly about this slide. You'll see the different colours there. I hope you can all see the key well enough to read it. But these green bonds are being issued really from a variety of different places. So the green bond market started from development banks, but now we see like financial corporates, non-financial corporates, local governments, government-backed entities. In the very end of 2016, we saw the first sovereign green bond issued. We've now seen a few sovereign green bonds issued. So the issuer type is really diversifying. And the kind of use of proceeds is also really diversifying at the same time. So when green bond issuance started, it started early on. There was really predominantly renewable energy that was being used for the use of proceeds and green bonds was going towards. I think that was the most obvious place for green bonds to be issued first. Issuers understood that a green bond was an appropriate mechanism to use. Investors also understood that if they were putting their money in a green bond that was going towards renewable energy, then that was a safe bet to be calling it green. Over time, we've seen sort of newer sectors come in. And so last year, you can see this split. It's still quite heavily on the energy, but there's also a lot of green bonds being issued in the building space. So that's for energy efficient buildings, low carbon buildings. It can be for new buildings, or it could be for retrofitting old buildings. Also seeing a lot going on in the transport space. So a lot of rail is coming in, and that is mainly passenger rail, but also it can be like electrified freight rail and things like that. So you're seeing that a lot in the green bond market too. Water we're starting to see, and so with 21 billion last year issued for water projects. And then these last three sectors, so waste, land use and adaptation, they're just kind of starting to come into the market, and you're starting to see green bonds being issued in these spaces. So yeah, I mean, land use, you can see there land use was 5 billion last year, 4%. So far it's 4% this year. We'll see how high that gets by the end of the year. But it's not taking up a big portion of the green bond market at the moment. And I think one of the big reasons for that is it's just not as clear cut what can be put into green bond in the land use space. Issuers are worried that if they put something that then gets criticised later, they'll suffer that backlash in terms of the PR benefits, but also in terms of the investor confidence in their green bond. So yeah, but then also it just, the land use stuff doesn't have quite the same volume of financing as the renewable energies, but it can definitely take up a bigger share than it is at the moment. And the limiting factor on the green bond market right now really is the number of issuers that are bringing green bonds to market. It's not limited by the investor demand. Investor demand at the moment, it far exceeds the supply. So green bonds that are coming to market, they're being bought and they're being oversubscribed. So we need to really try and push more issuance rather than more investor demand. So then I've pulled together a table here of all the green bonds that have been issued in the forestry sector at the moment. This isn't absolutely all of them. I think there was a couple of others that just wouldn't have fitted on the slide, but this is the majority of them. And you can see from the names and the different organisations, so just to pull out a few, we've got quite a mixture of issuer type here. So you've got a couple of banks, you've got some corporates, so Svezkog and Suzano, and then you've got some government-backed entities as well in there. There's not a big diversity in country in terms of where we're seeing forestry green bonds coming from. We've seen there's 3 places: Sweden, Brazil, and the US. It's not surprising that these are the countries that are leading, and I expect in the near future the next green bonds will probably be coming from either Sweden or Brazil again. But there is a possibility to open this up a lot more, and we've heard other countries, like issuers in other countries, especially in the Nordic regions, that would be interested to use this. But I think New Zealand, Canada, countries like that as well will probably also join in issuing green bonds for forestry projects. It's also quite likely that we'll see sovereign issuers, including some forestry in green bonds that they do as well. I think they're quite a likely target from forestry issuance. So then if we take a look at the use of proceeds, so I put as much detail in here I put quite a bit of detail in here, so that I think the presentation will be shared afterwards, so you can use that and have a look for a bit more detail. But just a couple of things to point out. Quite a lot of the green bonds issued in the forestry space, they have to give a justification as to why the proceeds are green, and a lot of them at the moment, what we're most commonly seeing as to form part of that justification is the FSC or PEFC certification. So you can see Lands Hypothek Bank, they justified that their forestry, they would make loans to FSC or PEFC certified forestry assets. Svezkog also have referenced the FSC certified forestry. Klabin have too. It's quite a common way. I think people they know that investors will understand what FSC is, at least to some degree, and so it's an easy way for them to kind of give this justification as to why it's eligible for green bond financing. Then a couple of other things to point out, that we see a few different ways they sort of explain their use of proceeds. Sometimes they'll explain that they're going to specific projects. So it could be like reforestation, afforestation, conservation of a particular woodland. Or in this case of FESCOG, what they've done is that it's a general corporate, all the proceeds will go to general corporate expenditure. And that's because their whole business model is around FSC certified forestry. So they haven't felt the need to pull out specific projects and explain which projects that the proceeds from that particular bond will go to. Instead, they've sort of justified the use of proceeds by saying everything we do is FSC certified. It's all responsible, sustainably managed forests, and so we're going to issue a general corporate bond. And then the final thing, just to point out about this use of proceeds, is that not all of these bonds were issued just to finance forestry projects. So Clabin is a good example. They have issued a bond. Part of it is for FSC certified forestry activities, but other parts are for renewable energy, clean transport, energy efficiency, waste management. So there's a whole heap of other things in there that they're also classifying as green. And if, like, when you see the development banks issue a green bond, it's quite likely they do similarly. They'll have a portion of it that will go to forestry, but a portion might go to green buildings. A portion might go to clean transport. And I think the sovereigns will do the same as well, because they're much more likely to issue quite large bonds. Therefore, they're going to only a portion will go to forestry, and that doing it that way is entirely acceptable in the green bond market, as long as you're justifying why each part of the bond is green. Then you can put in a mixture of different asset types. It's pretty common to see that. In terms of criteria that an issuer, a forestry issuer, would have to meet in the green bond market, there's nothing set. So there's no set rules saying if you're going to put forestry assets into a green bond, they need to be either FSC certified, or you need to kind of show us you're not converting land from natural forest. There aren't rules. It's up to the issuer to explain why their bond fits in the kind of green financing market, and then the investors either take it or leave it based on that justification. There's second party opinions out there, so they might get like a audit firm to have a look at their green bond framework and give an opinion as to whether they also agree it's green, but that's still not against a set framework. There's the green bond principles, which I don't know how familiar everyone's with the green bond principles, but they have broad categories that say these are the broad areas that use of proceeds can be used for. But the literal wording of the green bond principles in this area is environmentally sustainable management of living natural resources and land use. It's very broad. You could fit a lot under that. And so based on that kind of rationale, this is why we put together criteria in lots of sectors, but it's the same rationale for why we put forestry criteria together. There's not that guidance at the moment, and given that forestry projects are not always going to be climate friendly, we feel that you need to have criteria in place that then issuers can adhere to say our bond really is green, we've adhered to these criteria. And when we're the kind of overarching principle we use when we're designing criteria is that we want to push green bonds to only be funding projects that are ambitious on the climate front. We're not looking for we don't really want to recognise incremental changes. We want to recognise the ones that really are ambitious and really are 2-degree compliant. So it's less easy to give an example of that in the forestry space, but if you're talking about energy efficiency, we wouldn't be certifying something that kind of reduces energy use by 5%, but something that reduces energy use by like 50%, maybe that's good enough. So it's that kind of ambition that we're looking to see, and that's what we use to kind of drive our criteria development. So the criteria that we have built, they're built around ensuring that forestry projects are climate compatible and also are climate resilient, and that's to recognise the fact that there will be some level of climate change is going to happen, and if your project is mitigating but not resilient, then it's not much good. It needs to be mitigating and resilient. And the final thing that the criteria are built to do is that they're built to have issuers and investors, give them guidance on for investors. It's guidance on what sort of things should you be looking out for if you want to invest your money in green and you want to invest it in forestry. What sort of things should you be looking out for to know that the investment you're making is climate friendly? And for issuers, it's to say, if you've got these kind of projects, you can use them for climate finance, you can use them for green finance. It's a good way to finance your projects. So yeah, that's kind of the background onto the green bond market and to the forestry sector, and why we think forestry criteria are needed. So we currently have our forestry criteria out for public consultation. The public consultation is actually coming quite close to the end. It's closing on the 20th of July. So we're gathering comment at the moment. I'll pass to Lewis in a second, but after he's spoken, I'll go a bit more over the principles that are going to be behind our criteria and what we're going to be looking for in terms of compliance, and how we've developed them, because it's very important to us that we really have done a multi-stakeholder approach in development of the criteria. It's not just my voice saying this is what I think forestry criteria should be. I don't think that'd be a very robust way to do it. So once Lewis has spoken over his slides, then I'll give everyone a kind of introduction to what we've got in our criteria. So Lewis, I can pass over to you now, but I guess I need to stop sharing my screen.
Thank you, Katie. Hi everyone, can you hear me? Is it?
Yeah, I can hear. Yeah.
Okay, excellent. So. My name is Luis Silva. I'm a forest practice expert, and I'm leading the new Generation Plantations platform. Let me just quickly share my screen with you. Just let me know if you can see my screen now. Is it okay?
Yes.
Yes. Okay.
Yes. Very good.
So we thought it would be interesting to bring to this presentation an example how we see that plantations, well-managed plantations, combined with the conservation in the landscapes, can link into the concept of green bonds, as Katie was describing it. Just to quickly start, by those who were less familiar with New Generation Plantations, this is a platform which is managed and coordinated by WWF Network. Its participants are private forestry companies and also some public administration agencies. Currently, we have about 15 participants, 12 companies and 3 state forestry agencies. Typically, it's large operations, so an estimated aggregated value of participants, it's around $100 billion US. And also they are managing quite large extensions of land. Currently, around 11 million hectares of land are under direct management of the NGP participants, which are typically in thought and best management practices. So currently the plantations area and the NGP participants are nearly 100% FSC certified, and 45% of this land is to plantations, while The rest, about 6 million hectares, they are dedicated to conservation, restoration, also grazing and agriculture areas. The way the platform works, it's around what we define as the new generation plantation concept. So it's the glue that brings all these organizations together, or it is our aspirational vision where we think that the continuous improvement work needs to be guiding us towards. This concept, it's based on 4 principles. So new generation plantations are the ones that maintain ecosystems integrity, do protect and enhance the high conservation values, are developed through effective stakeholder involvement processes, and do contribute to economic growth and employment. Through other words, new generation plantations, they create shared value and high conservation values. So it has 3 strong pillars as WWF vision on sustainability: the environmental, the social, but in the center of our concept, it's the economic pillar, also performing equally to the others. I wanted to bring one of the examples that Katie mentioned from one of the NGP participants, Suzano. They have raised in the last 2 years through their green bonds nearly to $1 billion US. And this links with the new generation plantation concept in a way that it takes a landscape approach, and the green bond is a vehicle which allows an operation like Suzano to bundle the different investments that they have through their operations. As Katie described, it includes, as part of the bond, the environmental dimension of the industrial operations that the company has through its territory. It includes the environmental dimensions of their commercial operations, also through the various sites of the company. And this is the interesting and important part for us to understand. It includes the non-commercial investments, which normally they are quite large scale, given that Suzano alone it's managing about 1 million hectares in Brazil. And it includes quite large investments on actions like restoration, conservation of natural ecosystems, operations with small growers and outgrowers, certification, and so the aspects which they might not be a commercial operation in itself, but they are essential for the sustainability of the overall investment of the company. And that's the added value of a vehicle such as Green Bond for the NGP participants, because they allowed the company to maximize their selling point and their added value when they comply on their business model with concepts such as this one on the new generation plantation, because then the investor understands the environmental dimension of its investment. As Katie was saying, the green part of the investment operation. In particular, and given that when we describe what our vision on new generation plantations, it is basically a sustainable landscape approach, but in a production landscape. So we never talk and we never work on thin areas. It's where the human presence and activity exists for a long time. We are always working and trying to make the financial investment case for the natural capital. One dimension is that the restored land, it's much more valuable as capital, the land as non-restored as compared to a degraded land, but also because then the commodity in case of Suzano, the pulp that they sell, the commodity, it's only sustainable as an entire operation if they include and they do have an environmental performance on the other non-production areas, the conservation and the restoration activities. And that's where the green bond as a vehicle might allow us then to find one possible solution to realize this financial investment case on natural capital. And with this, from our perspective, from the new generation plantation concept, it allows us to fully realize our vision, that long-term horizon that we see, when our understanding of a sustainable landscape, it needs to respond from one side to the human needs in terms of producing the different goods and services from on that landscape. It needs to have its environmental dimension on the environmental services, and if the natural ecosystems are not well preserved, then we need to activate the restoration investment. And in the end, at least on the plantations side, the mitigation in terms of climate change, it's something that will become increasingly important as we realize how much we'll need to do in terms of carbon dioxide removal, and the role that plantations which comply with the right safeguards such as FSC certification and the NGP concept, they can perform on that holistic understanding of the landscape. And so this was the case that I wanted to bring here into this webinar on green bonds, how we see that we can make a much larger use of this vehicle. As Katie was saying, today, it's still quite limited, the number of green bonds which are issued with the forestry sector, but we believe that we can do have a much more efficient and better use of this vehicle within the forestry sector. And I'll stop here. Katie, over to you. Thank you.
Thank you. Okay, let me get...
It's up to me to stop sharing.
Yeah, let me get my screen back up.
Okay.
Oh, I think... Okay. Can you see that?
Not yet, at least.
Oh, here we go.
Yes.
Okay, great. Okay, so yeah, I wanted to go into a bit more detail about the forestry criteria that we've developed and that are in public consultation at the moment. So while these are aimed at green bonds, they can actually be used for many types of green finance, not just green bonds, so green loans, private placements, asset-backed securities, that they are really applicable to most types of green finance. So I wanted to just quickly go over the process that we go through to develop them, because we try and make it as multi-stakeholder a process as possible. So at the beginning, we convene a group which we refer to as the technical working group, and that's made up of experts in the field who are working in the field but wouldn't have any conflict of interest in designing the criteria. So the technical working group doesn't include potential issuers of green bonds or potential investors of green bonds or any of the verifiers that would be checking against the criteria that do get set. But the people that do work on the technical working group are NGOs, academics, those sorts of people that are really specializing in whichever sector it is. So in this case, in the forestry sector, and particularly specializing in the forestry sector and climate change. Those are the kind of people that we bring together. We then
Katie, sorry, we just see 2 slides, so we can't read the text.
Oh, sorry, it's gone the wrong...
Yep, if you just make it bigger. Thank you.
Hang on. Can you see the big one now?
Nope.
No, the same.
The same.
You've just got it in presenter mode, I think.
No, so I've got 2 screens, and one of them...
You need to select the other screen.
Oh, sorry about this.
When you click share screen, it will show you the 2 options.
Yeah, it did before and then...
I've got your slides as well, if that helps. I could put them up.
Yeah, that might help. So I don't know why I'm struggling with it this time round.
No worries. Here, I'll grab them.
I don't know whether my computer doesn't seem to be responding properly.
Here we go. And you're on slide...
It should be slide
7. Yeah, here, I'll do it.
Process. Yeah.
This one. Yep.
Yeah. Thank you very much. Yeah. Okay. So it was just explaining about that first bit, the CBI preparation. So we pull together the technical working group, and then we hold technical working group meetings. So that they're monthly meetings, generally done over the phone, and that's to discuss. First of all, we generally kick off by discussing the scope of the criteria, so how much it's going to cover, and then moving on to actually setting the criteria, and it's the TWG that set the criteria. The next stage in the process is then convening an industry working group, and this is when we bring in the feedback of the people that will actually use the criteria, so the investors, the issuers, and the verifiers, and they feedback on whether they would be able to pull together the evidence to meet the criteria. That is the big thing they feedback on, because if they're really not practical and feasible for use, then we have to reevaluate whether we're asking for kind of the right questions to be answered. After that process, then we then go into public consultation with draft criteria. So that's where we're at right now with the Forestry. We run a couple of webinars, do as much outreach as possible, and just gather as much opinion from wherever as possible. That'll all be fed back to the technical working group and and decided if there's changes to be made. And then the final step is board approval of the criteria. We can go to the next slide. Oh, that's not.
No.
Hang on, go. That's okay.
Went too far.
Yeah, and that one with the list. So this is just to explain who was on our working group. So there's a few different people on there. We had Paul, who I think is on the call, was representing WWF on our technical working group. Also had people from Forest Trends, Indofor, Agrobanco, a few others. So this is the split between technical working group and industry working group. There was also a much larger land use technical working group which fed in the very early stages before it was split into just forestry, and all of that's detailed on the website if you want to see any more information. So yeah, we can go down. So the scope of the forestry criteria, the scope was to cover pretty much all forestry. So what we've explained is that they cover plantation forestry, sustainable forest management, the harvest of non-timber forest products, forest conservation and restoration, other land conservation and restoration, and supporting infrastructure and some supply chain. So if an issuer is coming to market with a bond in any of these areas, these criteria are built to cover all of these areas. We can go down. And then I just wanted to, so just to explain, there's a lot more detail in the criteria document and background document, but I just wanted to give a really quick overview of what the overarching principles that we have applied to these, that we've developed for the forestry criteria. So there's a mitigation component and a resilience component, because as I explained a bit earlier, we see both of those two things as very important, and anyone who is looking to get climate bond certification under the forestry criteria will have to meet both the mitigation component and the resilience component. From having set up that there was going to be the mitigation and the resilience component, we then had quite a lot of discussion with the technical working group about what are the really big things that could mean that a forest is performing badly on a mitigation front, and how can we make sure we're controlling so that we're not certifying those forests that may be performing badly and not sequestering carbon. And the two big things that we came up with here are no natural land conversion, so that's no conversion from natural land to plantation forestry, and then also that forests that the forest health is maintained through good management practices. So those are the two big things on the mitigation component. How compliance is actually demonstrated with those it depends a bit on the type of forestry that is being practiced, but that's all detailed in the criteria document. And yeah, those are the two big things. And then on the resilience component, the big things that we're looking for are that the forest is managed in line with maintaining resilience, and that any impacts that climate change may cause, may bring to the area the forests in, are understood and mitigated so that they don't impact the forest. So that would be, for example, if temperature is rising, or if there's going to be more frequent droughts or just less water available, that is being anticipated, and the forest is being managed that it will be able to withstand those sorts of changes. So yeah, those are the kind of key things that we've laid out in the criteria. We have various ways that compliance is in there, but I don't think there's time here now to go through all the ways we're expecting compliance. So really happy to take any questions and or take further comments via email later. But I think, yeah, that kind of finishes up my slides for today, Natalia.
Sure. Thank you very much, Katie. Paul Chatterton, the head of the Landscape Finance Lab, is just on the line as well, and he just wanted to speak to the criteria for a moment. So, Paul, I'll hand it to you, and then we can go into questions because we've got a good 10 minutes left.
Yeah, thanks, Natalia, and thanks, Katie. Credit to you particularly, and Anna and Justine, for putting this together. It's been a real pleasure to be part of this process, and I've learned a tremendous amount. I think the result is, I'm really pleased with the result that's come out. But I'm sure I've missed something in the process, and it's a public consultation. We'll have internal consultation on this over the next few days. Look out for an email from myself and Joachim Krimphoff seeking your contributions on the draft forestry criteria. On the positive side, it sets proof of emission reductions against the baseline. It opposes use of funds for clearing or degrading native forests. It requires FSC and PEFC. It uses a zero conversion standard rather than a zero net conversion standard, which I think is remarkable. It's higher than the WWF standard has been in some ways. It prevents roading in intact forest landscapes. And it's one of the first measures that I've seen that recognises that the whole idea of intact forest landscapes. FSC does that, but not in the financial world. So well done. I really think this is remarkable. And when Luis is showing just how big the financial opportunities are for forest restoration and forest plantations, forest management. There's a $2.5 billion bond being constructed in India at the moment, I understand, on agriculture and forestry. So this is the first time I've seen anything that can really show the potential pathways to the bond challenge targets. How do we restore 350 million hectares of forest by 2030? This starts to show where the resources can come from, and Luis and NGP have companies who can deliver results. We need to find other partners like that. Exciting stuff. So just to look out for that email about the internal consultation. If give us your comments on the criteria, and we'll compile those next week. It's a fairly short deadline, I'm afraid, because it took us a while to get our act together. But the deadline for comments closes on the 17th, and then it'll give us a couple of days to compile everything and get it to Katie and the team, so that they have WF's official comments on this whole process. Thanks, Natalia.
Cool. Yep. No worries. So we've got a bit of time for questions. I think particularly maybe from people who are working on a forest landscape. I know we've got a couple of you in the call today. Are there any questions that you came up with while Katie and Luis were presenting, or anything that's relevant to your particular landscape?
Just a question for these bonds. Is it necessary to prove the additionality of getting this bond to undertake the project compared to the business as usual scenario?
I can answer. I can take that one first. It's not necessary to prove the additionality of the bond. This is one of the things that we talk about quite a lot in lots of different sectors, not just in the landscape stuff. Quite often with bonds, they're refinancing activities or projects that have already kicked off, and they're not the initial financing. So that's quite, when it's that kind of structure, it's quite difficult to then ask them to prove additionality, because the project is already up and working. And if it's a green project, we still want to be able to recognise that through our certification. It's not just about the new green projects, it's about the green projects that are already there as well. So I guess, yeah, the quick answer is no, you don't have to prove the additionality for this.
Thank you. We just had a question from Jackson too in the chat, asking, is there any distinction by the criteria on natural and plantation forests?
Yeah, there is distinction in kind of the way that they show compliance. For both plantation and natural forestry, we're looking to see whether the projects and the forests are FSC or PEFC certified. So that applies to both similarly. Then there's the distinction comes when you're talking about smallholders, because when we're talking about smallholders, we actually, instead of asking them to show that they're FSC or PEFC certified, we have a management plan that was designed for the smallholder case, because in recognition of the fact that smallholders may not get FSC or PEFC certification purely because of the cost of certification and not because they're not managing the forests well. So smallholders won't have to hold FSC or PEFC certification, but for natural forests, smallholders won't have to show that there's no conversion of natural landscape going on, because their activities are within the natural landscape. So whereas a plantation forestry smallholder would still have to prove that there's no conversion of natural landscape happening there. But I think that's the only, if I'm remembering correctly, I'm pretty sure that's the only difference, because then there's the resilience requirement is actually the same no matter what type of forestry you're practicing. It's process based, and it's a set of questions that's the same for all types of forestry.
Great, thank you. Is there anyone else who's working on a landscape? Maybe Fabi or Jamie, or Sheila, or William? Any of you guys had any questions with how this might relate to the landscapes you're working on? You might be muted if you're trying to ask. No? All right. Are there any other questions?
I might jump in.
Okay.
Yep.
For now.
William, we're just having trouble hearing you a bit.
May I go, Natalia?
Yes, yes, please.
For now, just continue.
Williams, I'm sorry, we're having real trouble hearing you. Maybe just type the question into the chat box and then we can ask it. Sorry about that. But Luis, did you want to?
Yes, I have a question to Katie. One of the biggest challenges we have, and even the large companies like Suzanne or UPM and others, it's to find capital for investment on the small owners. Do you think that the green bonds, through that process of bundling different types of investments under the big umbrella, could be a vehicle to find some solutions in terms of setting outgrower schemes and greenfield plantations investments with small forest owners? Do you think that could be something that the green bond would cover?
Yeah, I think they can. I think it's still gonna be a challenge because you'll need someone who's going to actually issue the bond to be able to do the bundling of. I think most likely we'd see it as you might see the development.
If it would be the company setting the bond, but one part of the money it was raising would cover those outgrower schemes and substitution of small owners.
Yeah, I think I think that it definitely could work, but I think the challenge will be that the way the criteria is set up is you need to show that the criteria are met for every kind of project line, if you know what I mean. So if there's the more that with smallholders, there's going to be more projects to show comply. So that is going to be a bit of a challenge, I think, there. But if the information is there and they can show compliance, then it definitely can work. And I think if they can structure it into a bond, there'd be no challenge finding the investors to invest in it. They would invest. In a sort of related point, we had quite a bit of conversation in the technical working group about one of the places we probably will see forestry bonds coming from is banks that are providing loans to smallholders. And again, that's going to be challenging to get them to provide the evidence to meet the criteria because of the number of different organisations they'll go to, but also because of the kind of distance they are from the actual forestry projects. So they have to collect information from another party rather than just having the information in their own operations themselves. And the banks can be quite resistant to gathering that information. But we didn't want to loosen any requirements on that basis. What we want to try and do instead is be very upfront and clear to the banks. Like, this is if you want to do a green bond in the forestry space, this is the information we are expecting, and this is the information we want you to be able to provide, and then hopefully they can start to ask for more information at the time of making the loan.
We do just have two last questions in the last minute that have come through. One from, can you guys both see the chat?
Yeah.
There's there's one from Jerome and one from Margaret. So Jerome is asking, are there any WWF projects that get financed by investments in green bonds, and who funds the work that you've described in this webinar? Do you want to take that one quickly and then answer Margaret's as well, and then we can wrap up?
Yeah, I can take the second part of that one.
Sure.
I'm not sure about the first part. Well, I can kind of take the second part, because the green bonds that are being invested in so far, it's just the same type of investors as as you would see investing. Well, it's likely to be the same type of investors that you would see investing in that company anyway, plus a few other ones that are looking particularly for the green bond label. So there are some investors out there that are looking particularly to hold bonds that have the green label. And so when an issuer issues a green bond, they tend to attract the same investors they would regularly, but also new investors who are looking for that green label. So that's kind of a quick answer to that one. And then to Margaret's question about the European Commission's Sustainable Finance Taxonomy, yeah, we're very closely involved in that. Sean Kidney, who's our CEO, is sitting on the technical expert group that is developing the Sustainable Finance Taxonomy, and we're trying to feed in all of these learnings that we've had. So we've got, alongside the forestry criteria, we've got criteria for most of the renewable energies, buildings, transport, bioenergy. So we're, and they've all been done with this multi-stakeholder approach that I described earlier. So we're trying to feed in all of that learning into that taxonomy and try and get them to use as much of it as they can. It's still really early days on that process because they had the first meeting last week and next meeting next week. And they have to deliver the mitigation part of the taxonomy Q1 2019, I think. So we're yet to see how much of what we've got already will be fed in, but yeah, we're trying to put as much as possible.
And Margaret, that last comment or question of yours, is that
about the reporting?
Yeah. So what's your experience of the quality of the reporting and the realized impacts of the investments?
So it varies a lot because there's not really a set format for reporting. Like the green bond principles states you have to do annual reporting, but there's not a set format in this is the reporting you have to do. So it does vary a lot. So I'm just having a look at the question. And yeah, because of that, you just see a massive range. Like some really do the minimum they absolutely have to, which is basically confirming that the projects they said they were financing at the beginning are still the projects they're financing now, or if the projects have switched over a bit, then they'll tell you which the new projects are, but they won't give you anything on the impacts. Others go a lot further and will sort of do explain the carbon emission savings that have happened, but that is really not standardized at the moment.
Okay, if that's it, I think we're starting to lose people. I think it's just we've run a little bit over time, but thank you both very much.
Thank you.
Thank you.
Yeah, and I will. I'll put both the slides and the recording up in the next day or so. So anyone that missed the last bit can do that. And then Katie, I know you put your email and Luis as well. I think in the in your slide decks. Is it okay if people email you with questions? And
yeah, absolutely. Happy to have any questions, and especially if it's on the criteria themselves, because that's open till the 20th of July for public consultation. But I know Paul said he's going to gather WWF opinions all together. But yeah, I'm happy to take any questions.
Is it an open consultation?
Yeah.
Okay.
Great. Okay.
Okay.
Thank you both.
Thank you for the invitation. It was a pleasure, Katie.
Thanks
Thank you, everyone.
Bye.